So welcome back to the Bacchus and Masuria Law Group's podcast, and we're doing this podcast in conjunction with Citywide Title here in the Chicagoland area. So thank you to Citywide for providing this to us. And for those of you who don't know, my name is Abby Bacchus, and I'm here with my law partner, Ronak Masuria.
Hi everyone, happy to be here.
And Ronak and I are law partners at the Bacchus and Masuria Law Group, and we have with us today a Loan Depot lender, one of my go-tos in the area, Mr. John Pawnin. John, welcome to the podcast.
Hey, well, thank you. Thanks for the invite. Thanks for the opportunity. Great meeting Ronak in person finally.
Yes.
And it's
you for
great
so long.
Yeah, you bet.
I know it's easy to do that when you have
Yeah.
everything is remote and easy to send things back and forth and sign them with the internet. So sometimes that happens.
The internets, yes, yeah.
Yeah. So John, aside from the fact that you're an experienced lender and also are you a active practicing attorney?
I am not a practicing attorney. I am a licensed attorney in the state of Wisconsin.
Okay. I didn't realize
it.
Okay, all right.
Yeah.
Are
I
you
never
still
got
licensed?
reciprocity in Illinois. I
Okay.
am still licensed. I'm just inactive. And I get asked all the time because, a lot of people want, not just lending to be like, hey, could you be my attorney too? I'm like,
Right.
nope, that would be a conflict of interest, so let's keep things separate.
Right.
I'm familiar with, obviously, a lot of the law related to real estate, but I keep things just focused on the lending aspect.
Yep.
It does give me, obviously, a perspective and try to anticipate possible issues that come forward. So generally speaking, I think that has helped. I mean, from a legal standpoint, my law degree affords me. I tell people I use it every day.
Yeah.
Because there are things in conversation. You're talking to people. It just helps to know the law, right? I think anyone should find that useful. But,
Absolutely. Yeah. I think that probably sets you apart in a lot of ways from other lenders. Not that you're giving legal advice or kind of working that in, but the fact that you have the background knowledge and a lot of law school and then being an attorney is putting together the pieces of a puzzle and figuring out the best. Right, it's problem solving, the most logical solution. So I think I can see how that would come in handy for a lender. So what else, John? How did you get into lending? How did you go from being an attorney to a lender?
You bet. I was practicing in Wisconsin. I was in a small firm, municipal attorney as well as insurance defense were the primary aspects of what I did. So I attended closings, occasional closings, but I represented municipalities, their end, so that kind of affords me that perspective. So people do ask me questions about like taxation, because it's a common thing that people will ask me, well, how do I go about lowering my property taxes? And, I can give them kind of both sides of it. Yeah, here's kind of the consumer or homeowners taxation responsibility, but then from a municipal standpoint, it's like, well, we really care. The principle is called lack of uniformity, right?
Mm-hmm.
We know this as attorneys. So some people think pie in the sky, I can get my taxes reduced. And it's like, well, that's not the way it works. Municipalities still have to make their bottom line. So there has to be a reason for it. So it kind of gives them and it eases them into it a little bit. Not that I'm, again, practicing that aspect, but at least it helps when I'm talking with homeowners and give them a realistic expectation of what they can do. Sure. When they're looking at a property and they're like, oh, the taxes on this are high. They may be, but there may be a reason why they're that high.
Yeah.
And I can kind of explain that to them.
Yeah.
So it's helpful. Yeah. So in that respect, again, going from the practice of law to being a lender, it was 2005. I can give you the year, and the reason why is because we all know kind of what happened between 2005 and 2008. It was just a great time to get into lending, I would say. But
You're in your heyday for a couple of years.
The heyday for me personally, it was a heyday for roughly 6 months, and then after that, it became like loss mitigation. What's happening? It's just the way it was with real estate at the time. We went through a housing crisis. I had the brokerage. I ran a mortgage brokerage for 12 years. Another 9 years after the crash. So I saw everything, and I think it prepared me, gave me a perspective when it comes to lending and to real estate and When folks come to me, like, has it ever been this bad before? I'm like, yeah, it's been bad, and you can give them that perspective, and also a way to prepare them. Like, well, here's what you need to do.
Right.
Don't just think everything now. Yes, values have all been increasing year over year, but guess what? It wasn't that long ago where values actually declined, and just imagine what is involved with that. So kind of to try to keep that perspective, anyway.
Yeah, absolutely.
Well, thanks for coming in to enlighten us with your wealth of knowledge. So jumping into the good stuff.
Good stuff.
With regards to first-time home buyers.
Yes.
And what they need to do before they even start looking for a home. What's the most important thing these home buyers need to consider before beginning their home search? Right.
Yeah. I mean, that's a great question. That's sort of the question when it comes to first-time home buyers, right? Because the first thing they'll ask whenever I speak with them is, how much house can I afford?
Yeah.
And it's like, well, you kind of have to answer that question, and to answer that in the form of budget. I always, just the way real estate is location. For us in lending, it's budget, because we look at the numbers and the systems that we work with. We defer to them in terms of approvals, and the systems will oftentimes approve people for way more than what they anticipate. And I always wanted to stress, figure out what you're comfortable paying on a monthly basis. Number one, I mean, you know what it's like, right? I see what's on your credit report. I'll see what the taxes are on the property, insurance, things like that. But okay, is $1,000 stretching my budget? Is $2,000? I mean, what's that number? What are you going to be comfortable with? Because guess what? That's not going to necessarily lower, if ever, through the life of owning that property. So you need to be comfortable with that payment, at least in the short term. I mean, be really comfortable with it. Yeah. So that's the number one thing, is come up with a budget. And I would say maybe 5% of the people I speak with, particularly first-time home buyers, will ever have an answer for that when I say, well, what are you comfortable paying on a monthly basis? So that's number one. Figure that out, because from there you can kind of extrapolate. Okay, here's what that monthly payment that you are comfortable paying. Here's what that'll afford you. Particularly if you're looking in a certain area that has a higher tax rate, or something like that. So that's why I always tell first-time home owners or people who are considering getting into home ownership, figure out your budget, number one. And then
and that's even before they get a realtor and start
right.
Farming, because you got to figure out really what you can afford and where. Otherwise you're wasting your own time and probably the realtor's time as well.
I mean, that's a great point. How many people, I would say, just like any consumer, the number of people that think, okay, I want to buy a house, so where do I start? Well, I'll start by looking at houses.
Right.
Or I'll start by talking with a realtor. I mean, oftentimes the realtor, when they talk with a realtor first, that realtor will say, hey, have you gotten pre-approved? Have you actually talked about finances with a lender? I mean, a responsible realtor. I can't imagine going to one and, hey, take a look at these properties, right? That seems counterproductive. But I think from a consumer standpoint, it's like buying a car. I want to buy a car, so I'm going to look at cars. It's not necessarily, well, I'm going to buy a car and see what I can afford, right? I mean, that's right, I think that's just human nature. So yeah.
What factors affect someone's ability to buy a home other than just their budget? The budget.
Well, that's it, right? The way to, I guess, break down qualifying for a mortgage would be three areas, I would say. Like, it's income, it's credit, and it's assets, right? I think, generally speaking, that's the three areas that people should focus in on. Right? You have to have income to be able to support that your debts, as well as this new debt you're going to be adding on. You have to have minimum credit standards, depending on whatever type of loan they end up going for. I mean, just and broadly speaking, like FHA can theoretically go down to a 520 credit score, which is kind of a low credit score, right?
It's lower than I would have thought,
right.
Actually.
Conventional, if you go with a conventional loan, the minimum credit score is a 620.
Okay.
And you can't get an approval. That's, at least with conventional, it's a hard stop. I say theoretical when I mention FHA, because FHA has not technically listed a minimum credit score in their guidelines. But most lenders will have what are called overlays, saying, we're just not going to lend to someone below a 580, below a 600, below, that kind of thing. So they have their own restrictions. Same with VA, same with USDA, all these different types of loans. They all have their own different credit standards. And assets, I kind of list last because, especially for first-time home buyers, there are programs that afford down payment assistance in certain circumstances. A lot of municipalities offer them. States, the state of Illinois has a great one. It's called IDA that offers down payment assistance. So assets, though important, I'd say it's always good to save, right? And it's one of the things that we look at as lenders is, does this candidate, does this borrower have the ability to save? Have they shown good
habits?
Credit, just like credit habits,
Sure.
right? It's saving habits.
Because that kind of shows a responsibility.
Yeah, I mean, the thing, the house, right? I mean, you hear all the cliches. It's the single largest purchase anyone makes in their lifetime.
Right.
I mean, it's not by a long shot, generally speaking, right? You go, well, there's a car. I'll buy a car for 30, 40. Nice car. Well, nice house. 300, 400, right? It's
10 times the amount.
Yeah, it's by a factor, right, of multiples. So, yeah, it's a big leap, and that's why it's always good to see that people have shown a history, because income is what income is, right? You can't really change your income. I suppose you can get a different job with higher pay, but it's not like, I'll just find that, and then I can afford more. But things you can do are you can save money, and you could maintain your credit, and so I know that's something that a lot of folks don't anticipate or don't work on, but credit is something you maintain. It's like, and everything's an analogy for me, but it's like going to the gym, right? You go to the gym, and some people, I'm going to go to the gym for a week and see how what the results are. They want
New Year's resolution.
The New Year's resolution. Yeah, perfect example, right? I'll make these immediate changes. Yeah, you may help slightly, immediately, but it's a long-term proposition, generally speaking, when it comes to credit. Even things that I'll pay off my credit card. Yeah, you may see a bump in a month, but more than likely, if you've shown a history of not paying your credit, it's going to take several months, if not a year, to improve your credit. So that's why things like that, there are simple things that a lot of people can do, thankfully. Just like working out, simple things you can do. It's just a matter of doing them.
And it's about it's about consistency over time.
That's right. Yeah, it's consistency. Yeah. That's, it's risk assessment.
Compound interest, kind of the same idea.
Right. Yeah. I'm like, I'll skip a credit card payment here or there, but the last 2 months I paid it on time. That's not going to cut it, right? Credit standards, typically it looks back 7 years.
Right.
And that's something that a lot of folks just don't keep in mind. So, yeah.
How long does the approval process take?
Approval process, well, okay, so it really kind of depends on credit. Not to belabor the point, but it's really important. If your credit's not in the best shape, and you're looking at, I have to repair it, then it could take, a month to a year or 2 years. Or if you had a negative credit event, like I had a bankruptcy recently, well, that automatically, if it's like a Chapter 7 bankruptcy, it's going to be 2 years at least. If you've had a foreclosure or had a deed in lieu of foreclosure, you're talking, 4 years to 7 years in that case. So it really depends on credit. Now, if your credit's like you've been good about maintaining your credit, then it's like a phone call. Then it's a conversation over the phone. You can generally get your information as long as your information is accurate. Tell folks it's sort of garbage in, garbage out. Be precise as much as you can. But if your credit's in good shape, you know what you make on a yearly basis, you have money in the bank for savings, then a pre-approval can take 5 minutes. Because we run your scenario, your information through what's called an automated underwriting system. Fannie Mae has one, Freddie Mac has one, and it's a matter of collecting, that basic income, asset, credit information, run it through the system, and you kind of wait for the wheels to spin, like, booting up your computer, and it'll tell you, in terms of Fannie Mae, it's called an approve eligible. In the case of Freddie Mac, it's called an accept. As long as it says that, then technically you are pre-approved. But again, that's the quick 5-minute pre-approval process. I think we should probably discuss something that's called a fully underwritten pre-approval, or TBD pre-approval. I think that's sort of the or preferred method that I like, because then you're taking the additional step of taking that automated approval and gathering documents. Like, you're basically applying for the mortgage. You found a property, you're applying for the mortgage, you're submitting it to an underwriter. Well, you're doing that, but you just don't have a property yet. Just think like, okay, what is the very most of this budget that we discussed earlier? What's the very most that will afford me? And let's throw that scenario to an underwriter and have them review your pay stubs, your W-2s, in cases of self-employment, tax returns, your savings, what you have in the bank. And lets them clear that credit aspect of your application. So then it puts you in a really solid footing, right? As a borrower, then you can go to a realtor at that point and say, hey, I just don't have a piece of paper from this loan officer. Now I have a piece of paper from an underwriter. They think I'm a good candidate for buying this home.
That makes your offer stronger.
It makes it super strong. And it also reduces the time frame, because most of what goes into an underwriting when you're buying a home is that credit application. Having an underwriter go through all of that information, plus in the case of a house or title, that kind of stuff, or insurance, they're reviewing all of that, and it takes time. But if you knock that part out, if you take care of that part, and all you're left with is a contract for the house, the appraisal, and the title, and insurance, then that's it. That's way less for them to review, and you can close potentially in 2 weeks. I've had borrowers who are, pre-approved, and they can close in 10 days.
Yeah.
Not too many sellers can close in 10 days if they're living in the house, but if you come into a seller and say, hey, seller, we can close in 2 weeks, they're like, well, that's great.
And I mean, it almost behaves then like a cash offer, in that they don't have to be as concerned about that contingency in the contract, that the buyer always has an out.
Right. I mean, think about it. You're selling something. You could remove as many unknowns as you can, right? X factors. Right. Well, that's a big one.
Yeah.
Well, will this borrower actually qualify for the loan?
Right.
Well, we already have an underwriter that says yes.
Right.
That's a big,
Yeah,
relief.
That's a big perk. And do you find that do you see that happening on a regular basis, where people are actually getting these underwritten?
Well, with my borrowers, yes, because I insist on it as long as they're willing to do it.
Okay.
Now, there's a commitment aspect, and I think a lot of borrowers are hesitant to commit.
I see.
Right, because they feel that they're kind of tied to you as the lender. And, I guess from a sales standpoint, there is that, right? Well, that kind of, but, that's sort of part and parcel of creating a relationship, that you're dealing with a borrower. They're putting their faith in you to get the loan closed, and you're putting your faith in them that they'll get you what you need. Right. So it's a two-way street. Mm-hmm. So yeah, I tend to highly recommend it, particularly for first-time home buyers, or particularly with self-employed folks.
Okay.
Because the more you can remove those unknowns, it does put them in a better footing. And I think I've had pretty good success, because it proves itself out, right? When you go out, in this market, which is still a very heavy, I would say, sellers market. It's lean sellers. Mm-hmm. There just isn't a lot of inventory, so more borrowers or buyers are competing for less properties. Mm-hmm. Well, if a seller is looking at 5-10 offers on a weekend, right, and they all look very similar, what is the seller looking for? They're looking for price, and they're looking for a borrower who could probably close in a short time frame, or that you have to show something else that sets you apart.
Right.
And other than, well, I'll come in at 10% higher, right? There's always that, right? The money
to
talks.
Some other contingency
or something. Yeah. Or there's no contingency, right? That's a good point.
Right.
So you have to find a way of setting yourself apart.
Yeah, and that's a great way because it also puts the buyer at ease when they're ready to go. You know, a lot of people have time frames. They're trying to maybe sell their own home, or they have to be out, or their lease is up, or whatever. It's a stressful time. So something like that, having that in hand when the offer is made, I can imagine that would be
for sure. Right. I mean,
comforting.
There's always a document right, at some point, because you're applying to buy something that's hundreds of thousands of dollars. Underwriters tend to want to look at you very closely, right? So the more you can kind of take care of that document dump ahead of time, I would figure as a buyer that gives you a sense of.
And how long is that pre-approval good for? Like, what if you're making a couple offers, and with this market you're just getting offers rejected? How long is?
Yeah, that's a good point. I mean, typically pre-approvals are good for 120 days because that's when credit, because it's all tied to credit. But with any pre-approval, it's really a matter of just updating the information.
Okay.
So in 120 days, you haven't found anything, I'll follow up, or you can follow up with your lender and say, what do I need to do to renew this? And it's basically, well, I just need to recheck your credit to make sure you didn't, buy a Maserati or something. I don't know, you didn't go and just, expose yourself to a whole bunch of additional debt, that your scores are still relatively in the same place, and maybe some pay stubs and a bank statement to show that all of that is relatively unchanged. That's really what it's about, are you kind of in the same situation? If things, now obviously, even during an underwriting process, let's say you're under contract and you're closing in a month. I've had this where buyers have said, hey, I've got a new job. They always tell you don't make any drastic changes, right? Don't don't make any large purchases, and unfortunately there are buyers who've sort of done both. Now the job situation, as long as the job is essentially you're making the same amount of income, or it's roughly the same type of work, if you go from, well, I'm salaried to now fully commissioned, or I'm going to self-employed, that's an immediate, okay, we're gonna have to restart.
Because they're
reapprove you, basically, because terms of your employment have changed,
has gone up,
right? Or you've bought a new car. Well, let's take this back, because we have to recalculate numbers. It's all about the numbers. And if suddenly you've got additional debt that we didn't have before when we first approved you, we've got to revisit the whole thing.
Yeah. Okay. Well, that's good information.
So we've talked extensively about how good credit is so important for home buyers.
Yep.
So how does someone build or maintain their credit profile to prepare for home buying?
Right, yeah, we can get granular on this. So I think the principles that I talk with when it comes to credit, simple stuff, which is if you can, all right, and for a lot of folks it's easier said than done, if you can maintain 3 credit lines, okay, whether it's an installment loan and 2 credit cards or 3 credit cards, that is sort of like the sweet spot. And that's, again, it's to show that you've had a history of using credit and you can pay it back. So you have 3 credit accounts, let's say there's 3 credit cards. If you can make sure that you never exceed 30% of the total line in those credit cards. And so to contextualize, I've had folks where it's like, I've got 4 credit cards, but I only really use 1. And they go and they max out that 1 every month.
Yeah.
Rather than doing that, because maxing out that every time you exceed 30% of that revolving line, that's considered a negative credit event, and it actually dings your credit every time. And they'll run it. Certain creditors will run it weekly, and every time they see that 30% exceeded, it'll say, hey, you've exceeded 30%, another couple points. So rather than doing that, how about you use spread the wealth?
Yeah.
Or I guess in certain circumstances, if you I'm going to put a large purchase on this card, you could do it. And I would say, well, one thing you may want to do then is go to your credit card and pay it off before the reporting period, or reduce that line to that 30% mark before the reporting period. So these are just like little tips. Older credit accounts, super important. So don't, if you have a lot of credit cards, I would not recommend closing credit accounts, particularly older ones. So if you've got like 5-6 credit cards, rather than closing those accounts, you just pay them to zero. Don't use them. Let the creditor, if the creditor closed that account, they don't hit you. That's not considered a negative event because the creditor took the initiative.
Okay.
If you start closing credit cards, creditors will see that as, okay, that's not a good behavior.
So you want to just keep all of your credit cards, but only really have 3 active credit cards. And you want to pay them off each month, and you don't want to exceed 30% of whatever the total allowable balance is or whatever.
Just to clarify, you don't necessarily get hurt if you carry a balance forward, as long as that balance is less than 30%. Obviously, it's great if you could pay off all your debts every single month, right?
Okay.
But the reality is a lot of people can't.
Okay.
They use a credit card for a reason. They need
you can't carry over more than 30% on each card.
I would recommend against it, because you will get, that is considered the negative event.
Gotcha.
So yeah, if you can keep and maintain 3 credit lines.
And is that for a married couple and an individual? Does it matter? Is it 3 and 3? You know what I mean?
Yeah, that's a good question. It's whatever reports on your credit card. So if you are, for instance, if you're a authorized user, that's an account. That counts as an account for you, even though you're not the one really using it. But it's reported against your credit. It's reported on your credit as an actual account. So
be careful who you marry.
Well,
that applies in more.
You're right. More than one way.
Yeah, it's not just who you marry. I've had a lot of folks that are like, well, I'll be a co-signer.
Yeah.
Right?
Yeah,
they become a co-signer on a credit card.
Yeah.
Or they become a co-signer on a car. Again, that's great. You're doing it for to help your friend, help out help out your family member, but be sure that your family member stays on top.
Yeah.
I mean, that's the thing. When you become an authorized user, you shouldn't be a passive user. You should be like, hey, by the way, you're making that payment, right? Everything's good. Everything's paid on time. So many times I've had folks who are like, oh yeah, my credit's great. I pay everything on time, and then I'll check them like, you've got an account that's an authorized user account. And it becomes fireworks. Oh my gosh, I can't believe they let that happen.
Yeah.
And it's like,
You're
we can't really do anything at this point. I mean, so make sure you kind of stay on top of it, because if it's on your credit, it's yours, whether or not you're using it.
Do you think people should pull their credit reports just to know what's, Yeah,
it's a good question. I mean, the other thing I would say is you want to use some kind of credit checking service. The one I kind of recommend is, though you don't have to do it because a lot of people don't want to be inundated with offers, is Credit Karma. I use Credit Karma, but I'm good at just ignoring the offers. It's like, I don't need a new credit, because you will get inundated with offers, especially if your credit's in good shape. But what's nice about them is they tell you. I mean, the scores they give you are what's called Vantage scoring usually, or FICO 2.0, whatever. That's not what we use on for major purchases, because it doesn't report the same information. But what's nice is it at least tells you around where your credit scores are, and it tells you where it's trending too. Like you'll see a green arrow or a red arrow, and it's like, well, if you see a red arrow, find out why.
Okay.
It's because you've exceeded a balance, or hope you don't have a late, because that's a late payment or whatever. That usually is a big red mark. But that way you're seeing what's showing, and they give notifications too, like, hey, your credit is improved, or your credit's decreasing. That's always a good thing. So I would say use some kind of credit maintenance. A lot of credit cards too. I know Discover or Chase Bank.
Citibank.
They give you
a free
once
a year or something.
Well, they send it to you monthly, but they'll send you one score.
Or Citi card.
Right. They send you one of your scores.
Yeah.
So that's it. Just have an idea. You don't want to go into it. A lot of folks I talk with, I've never checked my credit. I have no idea. I'm like, well, that's not optimal.
Yeah.
And then the last thing about that is, there's one other thing I was going to say about maintaining credit. We may have to, I guess, I'll request that. Can we change
We
that?
can change that.
Yeah, what was that on? There was something else about, oh, fear freezing. Okay, so the last thing I would say is when you're not using your credit, you're not applying for like a house or a car, is to have your credit frozen with all three bureaus. It's an easy thing. You can do it online. And that way someone cannot access your credit account without your explicit authorization. I mean, you'd be surprised. There's very limited or little information that's needed to access someone's credit information. So if you at least freeze it with Experian, Equifax, and TransUnion, they can't summarily just start checking things.
That's interesting.
Yeah.
Because when you get a check like that, it brings your score down, correct?
When there is a consumer inquiry, okay, and if it's just one, if it's like one within 6 months or one within a month, there is no impact.
Okay.
What happens with a lot of folks is they're like, I'm going to go buy a car. So they go to a dealership, and then they go to another dealership. And dealerships like to check your credit.
Yeah.
And anytime they check your credit and they see it done multiple times, and the other thing too is I've seen this, where they go to one dealership, and that one dealership
shops around for different loans.
Yes,
and then they all start checking your credit.
And they all start checking.
Yeah.
So that will certainly impact your credit. And it can be anywhere from a couple points to 10, 20 points if they do it enough. And if you're on the precipice, I say we're on a threshold, the way the credit works is it's 20-point increments, right? It's like 700, 720, 740, 760. Below each of those tiers, your credit will impact the terms you receive. From a mortgage standpoint, 760 and above typically is the highest tier. Fannie Mae and Freddie Mac, that's the highest tier. So 760 to the theoretical perfect score of 850, you're getting the same, credit or offerings between those marks.
Okay.
You're below, you're at 759. You're at a credit downgrade. You'll get a ding on what you're receiving in terms of offerings from lenders. 740, 739, another tier. 720. So you could see, and so many times I've worked with folks where they're at 759 or they're at 739. It's like that one score. It's like, well, I shouldn't have had my credit checked by the dealership or the car dealership or something, right? Just that one score will make a difference. And there's like, oh, can you give me a break? And sorry, that's not the way it works. You don't get a break. So
yeah.
Interesting. We've talked about the minimum credit requirements to qualify for certain kinds of loans, like FHA and conventional, things like that. Are there minimum down payment requirements to qualify for different kinds of loans?
Yeah, there are. As a return, so if you bought a property and you're going to sell it and buy something new, you're considered what's called a return buyer. Typically, for a conventional loan, you need at least 5% as a return buyer. Of course, there are caveats to that. If you are buying a new property with someone who's also a first-time home buyer, you get to now buy the property with 3% down on a conventional loan. FHA requires 3.5% down kind of universally. You'll always need 3.5% down.
Okay.
VA, you're a vet, you don't have to have any down payment because that's your eligibility. You've earned that right. USDA, for people buying in certain rural or designated agricultural areas, they aren't required to have a down payment. USDA is providing that assurance. And the reason why is they've assessed risk. It's all about risk assessment. And they see that if people have money that it's available for a down payment, they're less risk than someone who has, I've not been able to save anything. Right?
Yeah.
Now, I say that, but there's also what I mentioned before, down payment assistance. And like in the state of Illinois, you can get $10,000 from IDA, and you could use that $10,000 towards that 3% on a conventional loan or 3.5% on FHA. That being said, there are still going to be closing costs, right? We know this. You guys go to closings, you see all there's a lot of fees that are involved with buying a home. you've got title. That's a big one around here. We're at Citywide Title. So, little plug for Citywide. There's going to be title costs. There's going to be escrow. As a first-time home buyer, if you are buying a property with less than 20% down, you are required to have an escrow account. So you're going to have to fund that escrow account, which is going to be months of insurance, months of taxes. You're going to have to pay for the first full year of insurance to buy the house. All those fees start to add up when you're buying a home. So I typically, even for first-time home buyers, I kind of recommend having 5 to 6% if they can. That way they'll have the money for the down payment. They'll have the money for the closing costs. As an alternative, if you're getting down payment assistance, you could certainly ask the seller for a closing cost credit. You could, in cases of conventional loans, you can ask for 3%. Typically, if you've got less than 10% down, or FHA, you can ask for up to 6%. And really, that all just allows you to, have someone else cover those closing costs, which can add up. But obviously, we discussed this before. When you are making a competitive offer on a house, how many sellers want to pay for those closing costs?
Yeah, not many.
they typically don't, right? So,
yeah.
Do you find, in this market with the low inventory, we've seen a lot of people kind of moving into the rental space.
Mm-hmm.
And I think a lot of people initially or in the past have thought of that as like they're getting something less expensive by going into that rental space. Is it really less expensive for people to rent as opposed to buy?
Well, yeah. That's sort of been like the universal, right? Do I buy or do I rent? And I suppose if you could find a rental property, typically rents will be cheaper, right? If you're versus buying a house where you have a mortgage.
You would think so, but nowadays things are a little
You would think
lopsided.
so. I'd say that, right.
Yeah.
But the thing that's always made buying sort of the preferred way is that's typically how people build wealth in America, right? It's nice to own a home, be able to do with it what you want. There's that. Mm-hmm. But in terms of wealth, building wealth, there just aren't a lot of people who, when they rent and they're saving that money as opposed to buying, they're taking that savings and are they investing it? Are they, putting in their retirement? Are they actively doing that? Mm-hmm. I suppose if you're doing it, then you're realizing the benefits of that lower cost for living. But a lot of folks just don't. It's just a reality of it, right? I'm saving and I can use that money towards a vacation, or I could use it for other things to live my life and live a better, a more comfortable life. Yeah. So I'd say it's interesting that the Fed did an actual study of this about 3 years ago, and they found, and the data proves it out, is that homeowners or people who own property are 40 times wealthier than people who just rent. Mm-hmm. Okay, and that's as a comparison. Like, okay, I rent, I save away for my retirement. But one thing you're doing is that rent is just going away, right?
Yeah,
that's
you're never
money.
Get it back.
You're never getting that money back. You own that home, you are building equity and you're paying down debt, that obligation you have. So when it's all said and done, that house, which is also appreciating in value after 30 years, now you've got, $300,000, $400,000 in equity, right?
Yeah.
Even if you're just thinking in dollars and cents, right? Versus someone who's been renting the whole time. So therein lies that difference. That's that 40% wealthier.
Yeah. Is it better? We're coming up on the holiday season. The interest rates are kind of looking like they were coming down a little bit. They've kind of evened out here. Is this a good time to buy, or should people wait? That
is the question, right? I get all the time. Mm-hmm. I'm gonna wait until borrowing costs come down, when rates improve. I'm gonna wait until there's more inventory. Well, so my general sense, and this is someone who's been active in the markets, both on the Wall Street side as well as the housing market side, is it's typically not a good idea to wait. Waiting leads to things like more expensive homes. That's the thing about assets, is they appreciate in value, right? So a house that you're looking to buy now, that house is probably going to be worth more in 6 months to a year. So that's one. So let's say you wait, and you were right, and maybe rates were coming down a little bit, and they did come down. They've come down pretty significantly over the past 8 months, right? But during that time, what's happened with inventory? Has inventory improved? Not really.
No.
There's still nothing to buy, and people are still putting in multiple offers. So houses are more expensive. Yeah, you may have gotten a break on interest rates, though. Is that something really you want to kind of bet on? It's a bit of gambling, right? I'm anticipating rates will be lower. Yeah, consensus tends to think that rates will improve.
And you can always refinance if they come down.
You could refinance a house you own. You can't refinance when you don't, right? Or that one that's sold. So, yeah, it's typically better to participate in a market sooner. It's better to buy Apple sooner than to wait and buy it later, right? So that's just kind of my general sentiment when it comes to participating in markets.
Sure. What about fixer-uppers? Those are usually more affordable. I mean, for people, and sometimes people can actually turn those into lucrative investments.
For sure, yeah.
Are there specific loans for those types of buyers?
There are what are called renovation loans. FHA offered what's called a 203K loan. They've offered it for the better part of 2 decades now. And what's interesting about these renovation loans is they offer you funds to both acquire properties and also to renovate them. So that's what is unique about them. You can actually borrow against the future value or the after improved value of a home. So that's a great point. There are properties that are sitting that don't get a lot of attention because they need a new roof. They need a new kitchen. They have their real estate owned by banks. They're REOs by banks, so there's a lot of neglect in them. So they are overlooked because a lot of folks, they focus in on the move-in ready, and it's all the time you see in a listing. They'll say move-in ready.
Yeah, people are busy.
Turnkey.
Yeah, turnkey. Everyone wants move-in ready and turnkey. But a house that's been sitting there, one, you may be able to negotiate that, especially if there's been no offers on it for 6 months to a year. So there's that. You can actually negotiate with the seller. And two, it may not be the home that you want right now, but you're renting for another 6 months to a year. Why not buy it, renovate it, and then make it the way you want in the future?
Customize it to the extent that you can.
Exactly. And then you can go back to what everyone talks about with real estate, which is location, 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 right? Then you can focus in on location. So many people have had to make accommodation with it's not really where I want to live, but it's a house I can afford.
Right.
The schools may not be what I want, but again, that's what I can find. So maybe you can find that house that's in the neighborhood or in the school district you like. It's just, the roof is leaking and the basement floods. I can get that rolled in. I can get the current acquisition. I can negotiate on the acquisition cost. I can get a contractor's bid and put it into what's called a work order. And assuming that all that's done, an appraiser will look at the repairs that are going to be made or the after improved value, and they'll say, now this house that is 30% lower than what's currently in that neighborhood will be at value,
right?
And afford someone the ability to not have to pay all that out of pocket.
Right.
That's really it. Whereas, I don't have roofs are expensive. I don't have $40,000 for a roof. Well, you can roll that into the loan.
Yeah.
So it's an option. And conventional offers it as well. I mentioned FHA with 2 or 3Ks. Now Fannie Mae has a home styles loan, and Freddie has their choice renovation loan. So there are several different options for those.
I know. I actually love that option because I think it's so fun to do like that flipping stuff, and you need the right situation. You have to be able to stay in your current place, and so there has to be kind of that right situation going on.
Right.
And not everybody has that.
Not everyone has it.
So what about when you own a property and you think you need the proceeds from the sale of that property to purchase your next home? what I mean, are there any options for people? And as you know, if you come in with a contingent offer like that, a lot of sellers, particularly in this market, because they don't need to deal with that sort of risk, they turn down those offers.
Right.
So is there any sort of like a bridge or something that you guys offer to be able to facilitate those kinds of loans? Or
that's a great question. I mean, obviously contingent offers right now, even sometimes financed offers. I've seen that where it's like, we're not accepting financed offers. I'm like, what does that mean? You need to have you need to have $1 million sitting in the bank. How does that sound? So you just can accept cash. I'm like, that it's wild to me, but whatever. People were doing it. So having a contingent offer is oftentimes difficult in a seller market, right? So there are a couple ways of going about it, or a few ways to go about it. There's, I can qualify carrying 2 mortgages. I mean, there's that. They have some savings. They have money in their retirement. They could pull it out temporarily until they sell the home, and then they could basically pay themselves back. There's that.
Yep.
Then there's the bridge loan option.
I didn't even really realize that it was called a bridge loan. I just thought we got to bridge the gap
there. It is called a bridge loan. I mean, for a
sense.
while they were super popular before, again, the mortgage implosion or the housing crisis. But they've come back, and what basically it means is you're borrowing against the equity. Like you have an existing loan, but you have a lot of equity.
Yeah.
And that's important. A lot of equity. Bridge lenders, investors typically want to see quite a bit of equity in the home because they don't want you to exceed 80%. So let's say, you've got a loan that's still 20% of the house's value of your current place. So you paid off quite a bit of it. And in theory, then you've got, that you got your 20% of that equity eaten up by your existing loan, and you've got 60% before you get to that 80% mark that you would be able to use as basic collateral against that bridge loan. Because that bridge loan lender is not going to give you, my house is $400,000, I want to borrow $400,000. That's not the way it works.
Right.
They're still going to assume that there's a certain amount of risk if you end up not being able to sell for that price.
Sure.
So there's that traditional bridge loan model where they're essentially paying off your existing loan, giving you some additional money that you could use towards the purchase of the new home. So they're viewing it all as like a one blanket loan. I mean, blanket loan is actually a term to use in commercial, but that's essentially what they're doing. So they're combining the equities in two properties and debts in 2 properties to be able to buy a new property. And eventually you'll sell that existing loan, you'll pay off the bridge, and then you'll refinance that bridge loan into what's called a permanent loan. There's that traditional bridge loan option. There's also now an investor that allows what they're essentially doing is putting an offer or agreeing to purchase your property at an agreed upon price, which will be the list price you actually have to list the property for sale, and they'll let you borrow, or they'll give you funds based off of that list price, and you could use that as collateral for a new loan, which is actually a standalone second loan. So you can make a non-contingent offer on the purchase of a new home with just that single loan you're qualifying for. In worst case, if your property doesn't sell, which you anticipate doing an arm's length transaction on your current residence, if it doesn't sell, they agree to buy that property. It's kind of unique. It's new, and you're probably going to see more unique type bridge loan scenarios in the future, assuming that, of course, values continue. I mean, it's sort of the catch-22, or the big question when it comes to real estate is, assuming values continue to increase, you'll see more creative offerings like this. But it is the latest, probably most creative, and it's one that seems to have gained some traction. But understand, anytime you're doing a bridge loan, the terms are not going to be
favorable.
They're not going to be like getting a regular conventional loan. Okay. Like in the second option I mentioned, you are essentially getting like a conventional or FHA loan on that second or that new property. So in that sense, it's that one permanent loan, and then they're going to pay off. They're going to essentially buy that property, or you sell it and you pay them back. They're going to charge a fee to offer you that scenario, even on that second option I mentioned. they're going to make money, and because the turnaround time on this is quick, right? It's anticipated it's going to be 6 months or less. That investor charges 2%,
Oh.
and it's 2% on that list of
Yeah.
the house that you're selling. So imagine what that is. It's a list on $400,000. Well, it's 2%. That's a lot of money, right?
Yeah.
So typically, in my experience, folks who have gone the non-contingent route have done the first option that I mentioned, which is they're carrying, and it feels, they feel exposed for sure, but they're essentially carrying 2 mortgages, or qualifying for 2 mortgages and carrying them in the short term because they anticipate selling. I mean, luckily, I've not run into a situation because, again, this is such a strong seller's market that has not posed a problem, at least for me.
Yeah. So, I think we talked about a few things that people can do to set their offers apart. We talked about if they have a home that they need to sell, possibly reworking it into some sort of bridge loan, or, a way to kind of make it so you don't have to make a contingent offer. Obviously, that would put you at the bottom of the list if there are others that are of the same value without that contingency. Anything else? And then, anything else that you can think of from the lender's perspective, or, that would make an offer more attractive for buyers?
Yeah. I mean, we mentioned it before, which is getting your application
and an underwritten pre-approval.
Fully
that's
underwritten,
helpful. Yes.
pre-approved. Yes. If in certain circumstances, and you can do this if you have assets. There's one thing, it's not something that is guaranteed, essentially, but one thing that you're able to do as a lender is, if you run an actual address with an application, sometimes you can get what's called an appraisal waiver or PIW with a buyer. That assumes they have to have at least 10% down. Oftentimes you'll see they need to have 20% down. And there are certain things that are completely out of your control. I mean, it's going to be, is there enough data in Fannie Mae and Freddie Mac's system?
Okay.
Is the risk assessment of the overall file low enough where the system will come back with that appraisal waiver? That's something that I've had that listing agents have used and said, hey, my buyers in this case, we're able to do it. We're able to do it without an appraisal. I mean, you'll hear oftentimes an appraisal waiver from buyers saying, hey, whatever the value comes in, we'll bridge the gap. There's that, but it's also with the seller saying, hey, with our offer, we're not going to have to do an appraisal. We're not going to have to negotiate a possible change in terms later because the value is not supported.
And we see that come up in a lot of AI letters.
Right.
So that's the attorney review letters that the buyers send to the sellers' attorneys when they try to negotiate different things in the contract. And we see a lot of times that they're asking that if it comes in at a lower appraised, or the buyer will ask if it comes in at a lower appraised value, the seller, match that amount or give the buyer an option, whatever the case may be, to remedy that.
Yeah.
So yeah, that's an interesting.
Yeah. Well, another thing too, it is interesting. I mean, I guess not to, spill too many secrets. There's when it comes to programs,
that's what you're here for.
A lot of lenders don't want to share their trade secrets, whatever that means. But like FHA, we all know that kind of FHA gets a bad rap oftentimes. Yeah. In particularly in Wisconsin, because I lend in Wisconsin pretty frequently. Sellers and listing agents are very apprehensive about FHA deals, and it's because it's gotten a bad rap because FHA does require things like you have to inspect the attic. There's a habitability requirements. There can't be mold. There can't be chip paint.
Things. So the seller has to fix all that.
And the seller typically has to fix it. It is required to fix all that stuff. But here's something.
Well, can I ask you really quick before you go on? For an FHA loan, is there inspection requirements that are separate from a typical inspection? Does it like a separate person come out and do an independent inspection, or are there added things to the inspection? What's the
Yeah, that's a
difference
great
between
question.
the inspections?
Okay, so appraisers, there are appraisers who are certified in FHA loans. So you, in certain circumstances, if an appraiser that's part of the assignment, you send it over to them and say, this is for an FHA loan. They have to be approved to do FHA appraisals. So that's one. Most appraisers these days are FHA approved. It'd be kind of, I mean, you're turning away business by not doing that. The reason why is because the appraiser has to do things like, well, they have to comment about the attic. I mean, so in some circumstances, a conventional loan, they didn't get up to the attic, they didn't take a picture of it. That may be passable. If there's mold, they see mold, they have to notate that in their appraisal reports. If there's chip paint, they specifically have to notate that on the appraisal report. Mm-hmm. Those things aren't necessarily required on a conventional loan, though I would tell you a lot of conventional appraisers, they will catch those things under the umbrella of habitability. If mold is enough of an issue, visible, they're going to say that could be a health issue, mm-hmm. and they have to, they're required to comment that. Like, carbon monoxide detectors. A lot of folks think that they have to be within 10 feet of a bedroom. That's required by code. Some appraisers will comment on that. Some of them won't. They should. It's required.
So you're using the word appraiser. Yeah. And so, and maybe I'm just confused here, but is an appraiser different from an inspector?
Yes.
So when you're saying the appraiser notates that, you're saying the appraiser, the FHA certified appraiser, looks at the inspector's report.
They do not.
No. So they go out and do an independent inspection.
So the inspection, when people get inspections, which I recommend everyone gets an inspection when you buy a home, they're commenting for the buyer. Mm-hmm. We as lenders, I mean, I tell them that's something we don't need.
Yeah.
I mean, if you want me to look at it based on my experience, I can certainly look at it, but here's the rules with regard to that. If I see something in there that would be of concern to an underwriter, I am supposed to tell the underwriter, hey, this house has an issue.
You don't want to really see it.
So that's why I'm like, you kind of send that to me at your own risk. Mm-hmm. That is a separate thing. Again, everyone is recommended to do that. From our perspective as a lender, the appraiser goes out there to comment on value. Also, habitability. Is the house safe to live in? Because in case residential property, they have to live in it. So they're doing kind
of a double inspection then. If the buyer has the first one and then
they're not doing it to the extent. They're doing it for the bank and for the minimum habitability standards as prescribed by Fannie Mae, Freddie Mac, and FHA.
Understood. Okay.
So that's typically what they will do. Okay. The reason I mentioned FHA before and why it really has gotten a bad rap is FHA's got this nice little subset, the 203K loan, which when an appraiser, let's say, comes into a property and says, hey, here's the value, but it's got that mold, it's got the chip paint, it's got something that is what we call subject to, like I'll give this value, but subject to a railing being installed, fixed, something for safety. Here's the value. Everyone thinks that that's like doom and gloom. Oh, the FHA appraiser got me again. And, so then that's... But what's nice about that is, at least at Loan Depot, I mean, here's a little plug for Loan Depot, we can do a quick switch and say, okay, let's change this to a 203K loan. Let's get a contractor to come out and comment, here's what it would cost to fix this. As long as it's in there and within that appraiser's, because they'll put in subject to, here's the cost to cure, $1,000 to fix this, we're done. That's it. No change to anything. You don't have to change all of that.
So the seller doesn't have to fix the railing?
The seller does not have to fix it. And here's what's also
nice. Does the seller have to give a credit for that grant?
They do not have to give a credit. The buyer can pay for that. So
you mean the buyer can pay for it as it gets wrapped into the loan?
It gets wrapped into the loan.
I see.
So you're not having to, I mean, obviously in this market where sellers are like, I don't want to deal with any of that, right? I have 10 other buyers I can deal with who won't pressure me or cash deal. As a buyer, you don't want to poison that pill, right? I want to keep moving forward in this transaction. Or better yet, and this is something that's happened, is appraiser comes in and says subject to, and the value comes in a little bit light. Let's say they come in at, $500,000 5% lower than the agreed upon price because it's a competitive market and buyers are coming in high. FHA has a 110% tolerance on that 203K transaction. So no change. You don't have to change the purchase price. Don't have to do anything. Seller doesn't have to, revise or lower their accepted offer. You're good. You're golden. Conventional does not do that. You are having to go back to the seller and say, hey, you're going to need to fix the rail, you're going to need to fix the mold, and you're going to have to reduce your price by 5%. How do you feel about that, seller?
Do you feel like a lot of listing agents are aware that they can bulk back at that? Yeah, because I haven't seen that, and that's actually a powerful negotiation tool for people.
Yeah.
Potentially, you know what I mean?
For sure. I mean, but, it's like anything else. Hey, can I come into your office and talk to you about the benefits of FHA loans? Yeah, no, I think I'll pass. But they're huge. It's a huge benefit, yeah.
Very cool. So, John, lenders seem to be everywhere nowadays. We're like cockroaches. Lots of people who
like attorneys
want to want to lend people money. So what, in your opinion, are the three most important things for a consumer to consider when deciding which lender to work with?
Well, I mean, obviously there's you're going to hear the company line. Every company line says, our company offers all the programs and offers the best rates. Yeah. I mean, aside from that...
is it really just a rate comparison that people should be doing?
Oftentimes people will do that.
Right.
And if you're a top tier borrower, what I would call a vanilla borrower, there's no drama to you whatsoever. You're paid W-2, your credit is stellar. You can take that approach and hopefully it all works out, right? You can deal with the voice over the phone because that's all you need. The call center person who's handling the loan, because there aren't going to be the drama, the things that are involved there. But so many times, we both know this, you're dealing with a lot of X factors when you're buying a home. You're dealing with a seller who does not want to deal on some issue on a property inspection. Well, you have to be creative. Call center person's not going to know how to deal with that. So I would say the most important, I know you asked the three thing. I mean, you want them to be competitive on rates and fees. I mean, that's sort of a given. You have to be that.
And most of them are. They have to
most
be to
of them
survive.
Are. Right. There's no one in the industry. I can imagine talking with, what I sold this loan to? I can't believe they took this deal, right? I can't imagine.
So is it fair to say that people can pretty much expect kind of the same or very close to the same rates?
But at the same time, I guess the activity I would recommend to folks is you talk to at least 3 people, right? You talk to 3 or 4 different people. It's a phone call. Talk with them, give them, you don't have to be real specific, but you get a sense of if this person's a professional. Will they be able to deal with that unforeseen, right? The unknown unknowns, right? Will they? Is this someone you're going to be comfortable with in case something comes up? That's really it.
One of the biggest things that we see, because we work as a team, usually it's the attorneys, the agents, and the lender. On a deal, there's that dynamic always going on. And I gotta say, John, not a knock to your industry, but 99%
you could knock away. I knock the
issues that we run into are bad lenders. And I only say bad lenders, and they're not bad at shuffling, the paper, collecting data, and giving someone a loan. They're bad at communicating with the rest of the team, which can create a lot of problems. There's title agents involved. Things are moving quickly. Communication has to happen quickly.
You bet.
And especially when you're dealing with lenders who are out of state, sometimes in a completely different time zone. Sometimes they have completely different methods of closing. And Ronak and I have run into some really interesting, situations.
Right. Yeah.
That makes it clear that they don't understand how it works in the Chicagoland area, because it is different from how a closing and things work in other states. So, I think that the communication, your lender, being able to pick up your phone and call your lender and get that person directly and, within a reasonable amount of time is something that I think people should look for and expect in a lender. Would you agree?
Oh, yeah. Well, I mean, it's hard for me to really it gets to knock one way or the other, because these are what I kind of think are expectations, right?
Reasonable expectations.
Reasonable expectations. I mean,
we think so too.
I took it for granted before I started.
Right.
You know,
I mean, obviously,
doing
you as professionals, you have a team. You create a team,
Yeah.
and your expectation is, well, I have a problem. Something's come up. I need to call John, and I expect him to pick up the phone.
Right.
So there's one. And as a realtor, for sure, you would expect that, right? I've got
Yeah.
a question, and oftentimes I'll get a call from a listing agent, and they'll call up, and it's funny because they call me, I answer the phone. They're like, "Oh, you answered the phone." Like, yeah.
I know.
Kind of
everybody's
expected
shocked.
to, or I called them back because I wasn't able to answer right away. But
Yeah.
I called them right back, and
Yeah.
they're like, "Oh, great, you called me back."
Yeah.
Yeah, that's I
Yeah.
would expect.
Sort of how it works.
And it's funny because then they're like, and they want to start asking questions about the buyer, and obviously there's certain things they can ask, and certain
Yeah.
things that I can't answer, right?
Yes.
Like the financial situation, I can't
Right.
talk about their credit.
Yeah.
And I've had some listing agents ask, and I think part of it is just simply they wanted to talk with me to, one, make sure I'm real, two, that I've actually talked with the buyers, that I've assessed them.
So they can give their clients peace of mind.
Yeah, give their sellers, hey, this is going to be a good deal.
Yeah.
There's no anticipated, hubbub
Hiccups, yep.
or hiccups, and that's fine, right?
Yeah.
And that's expected. What I oftentimes tell, it starts with, well, I guess the realtors, they want to know that they're dealing with lenders, or they have a lending team that they do answer the phone, or they do answer questions when they have them. And then the buyers, that's one of the things is,
Yeah.
well, I've asked this lender series of questions. They don't seem to be forthcoming.
Yeah.
Right?
Yeah,
Which
yeah.
is
Definitely.
interesting. Or they haven't made suggestions. That's the other thing. I mean,
Yeah.
oftentimes I talk with folks, and they'll be like, I didn't know down payment assistance was an option. I didn't know that this program was available.
It's
I
more
thought
than
I
just
had to have
lending the
20%
money.
down.
It's counseling them
Right.
in the best, what's going to work the best for them, and give them the most optimal.
Right.
outcome,
It's funny. There's a word that you and I, fiduciary, right? It's
Yeah.
a funny word, and we know this as fiduciaries. I am technically a fiduciary, which means you are looking out for someone's financial interests.
Right.
And that's people oftentimes think with lenders that's not what we're there to do. We're there to sell the highest rate we can to make the most money we can. Like, no,
Yeah.
we're there as fiduciaries. We're making sure, one, we are counseling people on not just what they can do, but what they should do.
Right.
I mean, that's a lot of folks don't have that conversation because it's like, well, that's my business. I don't want someone telling me what I should do. I just want them to tell me what I can. I'm like, well, part of the deal, like
Yeah.
as an attorney, you're counseling them, you're advising them, right?
Right.
It's not just, oh, here's an answer or here's some data which you can get on the internet.
Right.
I think that this is probably a better approach.
Mhm.
So
Well, especially you're
Do
the
it.
one who is the professional, the one who's engrossed in this on a
Right.
regular basis, and you almost have a duty and an obligation, I think, when
right, yeah. Going back again to the
them.
house purchase. How many houses do
Right.
people generally, or transactions, do they experience in their life? 3, 4.
Yeah.
Not a lot.
Yeah.
So you can't really expect them. Well, I'm gonna be a seasoned professional. I've done, and
Right.
even after a few years,
Things are
all the
changed.
rules are
Yeah,
different,
I know.
right?
The rules just keep changing.
Yeah, how many calls have you had? It's like, that's
Yeah.
not what it was like last time I bought a home. Well,
Yeah.
things have happened since then.
Right, right.
Yeah, back
Yeah.
in 2000, so.
Oh my gosh.
Yeah.
Well, thank you, John. Thanks for joining us.
Well, thanks for the opportunity. It's all great talking with you guys. I mean, I can talk about all this all day.
I
Right?
know. I have to see you geeking out on it.
Yeah.
I love it.
Yeah.
If you could tell our listeners, how can they get in touch with you if they'd
Oh.
like to reach out?
You bet, yeah. My phone number is 847-268-8000. I know it's actually my personal number, and you can call that number nights and weekends. I answer the phone, believe it or not, whenever people are looking for homes nights and weekends, right? So, feel free to contact me that way. My email is jpaunan, John Paunan, at loandepot.com, and the website is loandepot.com/jpaunan, Paunan.
Okay.
Those are the best ways.
Great. That's
Thank
a wrap.
you.